Welcome to your channel. We will start this trade finance course by addressing some elementary topics. First, if you don't know what trade is, let me explain. Think of it as a very basic buying and selling transaction. You need something and purchase it from someone willing to sell it to you in exchange for money. Importers are buyers who purchase goods from exporters. The importer and exporter don't necessarily have to be from different countries. They can be in the same country, which is usually called local trade. Exporters are those who send goods to importers, meaning they are the sellers. Banks or institutions act as an intermediary. They make sure that payments are made on time, all the regulations are followed, and documents are in order. These can be international institutions as well. For example, the Asian Development Bank usually adds their confirmation to letters of credit or guarantees so that exporters' banks feel safe that their payments are confirmed. Freight forwarders, these guys handle the movement of goods, taking goods from the exporter and then arranging for the logistics to be delivered to the importer. Insurance companies, goods need to be insured in case something unforeseeable happens. In some cases, you can't get trade finance if you don't have insurance. Therefore, these insurance companies play an important role in trade finance. If you look up the definition of trade finance on Investopedia, it says trade finance represents the financial instruments and products that are used by companies to facilitate international trade and commerce. So, trade finance makes it possible for the buyers and sellers, in this case, importers and exporters respectively, to carry out transactions. It includes financing that is available from the financial institutions that enable the importers, exporters to carry out transactions smoothly. For example, consider Company A as an exporter. Company A has received an order to sell books to Company B in Poland, but Company A doesn't have enough money to manufacture the books or doesn't trust Company B since it is their first time doing business with them. In this case, Company A can ask for an advance payment. This way, they can not only secure their position, but also generate enough funds to fulfill the export order. For this transaction to take place, they need a bank in between to process the payment and handle the trade documents. Trade finance helped mitigate risk between companies A and B. In this case, it was a trust deficit. But in other cases, it can be currency fluctuations, or creditworthiness of the parties or even countries, liquidity issues, etc. Now, if we talk about the importance of trade finance from the perspective of global trade, you can say that it is the grease that helps the wheels of global trade to keep spinning smoothly, because it helps reduce the risk between the two unfamiliar companies. It also helps companies improve their liquidity by efficiently using trade finance products. It helps ensure that both parties hold their ends of the bargain and compliance with national, international rules and regulations. In the current times, there is a lot of attention on anti-money laundering and combating financial terrorism regulations. They are called in their short form as AML-CFT. With the presence of trade finance, the risk of transferring illicit funds can be mitigated. For example, when there is a bank present between importer and exporter, it will make sure that the documents presented related to the trade are genuine, and there is an exchange of goods. That is what you can call an arm's length transaction.